Hello and welcome to this session in which we will discuss what is included in the computation of the asset lease and the liability lease. Asset lease is the right of use asset. So what is required by the lessee, by the person who leases the asset? Well, lessees are required to record an asset called right of use asset and a liability for any leases, whether that lease is an operating lease or a finance lease, it doesn't really matter. So the entry would always be, the initial entry for a lease is right of use asset, right of use, which is an asset, and lease liability, which is a liability. Now bear in mind, the only leases that don't take this format, don't take this initial recording, if the lease is a short-term lease, less than 12 months, and there's no option, specifically no bargain purchase, we don't expect to purchase the asset, therefore it's basically a rental agreement. Otherwise, any leases, you have to debit an asset, credit a liability. So the question becomes, how much do we debit and how much do we credit? What's included in the debit and what's included in the credit? Let's start with the credit to kind of illustrate this concept. Think about a liability. What is included in a liability? When we think of a liability, especially long-term liabilities, liabilities are recorded at the present value of the payments. So what do we have to do? We have to figure out the payments. Also, these payments are discounted using a percentage. What percentage are we going to be using? And we're going to have many sorts of payment for a lease. We might have fixed payment, we might have variable payments, we might have a bargain purchase, we might have to come up with some money for the guarantee residual value. There are many payments. How do we deal with these payments? Also, how long is this lease? Remember, when we discount something, we have to figure out the period, which is N. The period, how long is this lease for? Is it for 3 years? Is it for 5 years? Is it for 7 years? How long is the N? How long is the lease? Regardless, the same entry, as I mentioned earlier, it is the same, whether we have a finance lease or an operating lease. But what we have to learn is what is included in the payment, what interest rate are we going to be using, and which period. And this is what we would learn in this session about what included, what's not included, obviously, how long is the lease for, and which percentage discount rate do we use. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Starting with the lease term, which is the N factor, the time. How long you will be leasing this lease? Well, is it 3 years, 4 years, 5 years? And when does it start? It starts as something called the commencement date of the lease. It's when the lessor makes the lease asset, the asset available for the lessee's use. And this marks the start of the lease. Not when you sign the lease, it's when you start to work with the lease. Now, what's included in the lease term? Well, you're going to start with the initial lease term. Every lease will have a certain term. The initial lease term is usually fixed, non-cancelable, and for a period of time allows the lessee to use the asset. And this initial lease term excludes any extension or renewable options. For example, a 5-year office space with no cancellation option defines the initial lease term as 5 years. Now, what about if we have a renewable option? In other words, it's for 5 years, but we can renew it. We will add to the lease only if it is likely that we are going to renew. The percentage is very high. There's a good probability, high probability, we are going to renew. If that's the case, we will add the extension. So if the lessee has the option to extend the lease and is likely to do so, this extension period is included in the lease term. So if a lease is expected to renew, if a lessee is expected to renew a 5-year lease for an additional 3 years due to favorable condition, the total lease term becomes 8. So you have to look at the contract and read it carefully.
there's an option to extend. Well, that's not enough. Is it likely to renew this option or not? And they will make it clearly in the problem whether it's likely that it's going to be renewed or not. They'll give you some hints. You would ignore if a lease has costly early termination option, and we assume that it won't be used. In other words, the lessee will not break the term of the lease. In other words, if they don't, there's no worry about this early termination option because there's a penalty, there's a payment. But if the lease is not going to be broken, we ignore this. And oftentimes, when we take the lease out, we assume it's not going to be broken. If it's broken, because it's going to be very costly to break it, therefore, we don't include this. Unless they tell you in the problem, it's expected to be, the lease is expected to be canceled early, which will include the penalty. If the option to extend the lease lies with the lessor. So, here what happened is this. The lessor has the option to extend the lease. Well, if that's the case, these periods are also included in the lease term. Simply put, if the lessor, because the logic is this, if the lessor, if the landlord, if the owner of this asset, it's in the business of leasing asset, and they have the option in the contract, they have the option to extend your lease, most likely they would extend the lease. Why? Because they want to do what? They want to do business. They want to keep those payments coming. This is the assumption. Let's take a look at lease payments. Now, there are many sorts of lease payments. So when calculating the lease payment, and those are the payments that we discount based on a percentage. So when they're calculating lease payment, lessee needs to consider several components to determine the total amount they will be responsible for during the lease. And what would those include? Well, they would include a required fixed payment. This includes all fixed payment outlined in the lease agreement minus any incentive provided to the lessee. Well, what does that mean? In the lease, they would say you are responsible for paying $5,000 per month. If they give you any incentive, for example, the first month I'm going to give you $1,000 off, you would take out the $1,000. Simply put, what we do is we take the payments and we compute their present value. So if you have a series of fixed payment or any payments, we compute them using the present value of an annuity, assuming they're all the same. Otherwise, we have to discount them separately. The lease might also have variable payments. And we could have several types of variable payments. We could have known variable payment. What does that mean? Those known variable payment are quasi-fixed. In what sense? For example, starting year 3, the payment will increase to $4,500. Let's assume the payment was $3,000. Then starting in year 3, they will increase your payment for $4,500. This payment is known. Basically, in a sense, it's part of the fixed payment, and it's included in the computation. So in the lease payment, it's included in the present value computation. Or you could have a payment based on some sort of an index, like this consumer price index or some sort of a rate, inflation rate. Lease payment or some sort of, other than inflation rate, any sorts of an index. Lease payments can include costs that vary based on an index or rate, like interest rate or inflation. You would include those. However, we might have performance or usage variable payment. What does that mean? For example, you lease a truck, you lease an office space, and the landlord would say, once you reach $1 million in sales, anything above this, I want 3% of that. That's part of the lease. Or if you're leasing my truck, once you drive it more than 100,000 miles, you gotta pay me $1 for every additional mile. Well, those performance or usage variable payment are not included in the lease payments because they are not known. So what do we do with them? We will expense them as they are incurred. So we have fixed payment, we have variable payments. How about if we have a bargain option purchase? Remember, a bargain purchase option gives you the right to do what? To buy this asset at the end of its life. If it's highly likely you are going to exercise, if there's a bargain purchase, which it means you are going to buy, we will include this in the lease payment calculation. And usually this is the present value of a single payment, the present value of 1. Also, if we have an end of lease purchase price, if the lease agreement gives the lessor the right to make the lessee buy the asset at the end of the lease, then this purchase price is also factored into the lease payment. Again, this is the present value of a single payment. Simply put, if you have the option and you are likely to exercise it, you would include it. If the lessor has the option to kind of force you based on the lease to buy it, we're going to say there's a good chance they're going to make you buy it, therefore factor that payment as well. Other lease payments, residual value guarantees. What is this? If the lessee guarantees a certain residual value for the leased asset, which is what's the residual value, the expected value at the end of the lease term. So when you bring back this asset, whatever that asset you are leasing, a piece of equipment, a vehicle, whatever you are doing, you guarantee that the value of this asset will be an X amount, $50,000. This guarantee amount is included in the lease payment calculation. Now, when do you include it and how do you include it? I'm going to explain. So, but what's the purpose of this residual value guaranteed? It's an incentive for you, the lessee, to take care of the property. So let's assume you guarantee the value of the asset to be $50,000, and you think it's going to be $50,000. You guarantee $50,000, and you think it's going to be $50,000. There's nothing you have to do. If you think it's going to be $45,000, you're going to be short $5,000. Therefore, you have to kind of include $5,000 in your computation. Bring the present value of $5,000 as an additional obligation. If probable, the value is $55,000. You don't have to worry about anything because the value is more than what's guaranteed. Now, bear in mind, if the lessee does not guarantee the residual value, then you don't include this into the computation. Also, if a bargain purchase option exists, what is a bargain purchase option? It means at the end of the lease, the lessee is highly likely to purchase the asset. Then you ignore residual value because you don't create a liability against yourself. No residual value is involved because you're going to take the asset, whether it's worth $10,000 or worth $10 million or $10. You don't have to worry about the residual value. You're responsible for that asset. How about if there's a termination penalties? If there are penalties for early termination of the lease that the lessee is likely to incur. Now you are likely to incur. If exercising a termination option is likely, these penalties are included. If not, you do not include. So when do you include a penalty? When you think you might have to do what? Incur that penalty. Why? Because you think in 3 years, I'm going to move, I'm going to have to break the lease. Or I'm going to need a new asset, I'm going to have to break the lease. Well, if you know that's the case, include that in the present value because you have an obligation. And the obligation is a liability. It's recorded at its present value. How about non-refundable deposits? Well, non-refundable deposits are part of the liabilities. Those are fees that the lessees pay to secure the right to use a leased asset. So you pay it to the lessor to do what? They said, please stop offering this asset to a third party. I'm interested. Say, okay, give me a security deposit. To do what? To reserve the asset for you, for the lessee. If those deposits are not returned to the lessee at the conclusion of the lease term, these payments are included in the payment of the lease liability as they represent part of the lease obligation under the lease contract. Now, if the deposits are refundable, if they are refundable in the form of receivable, you would record them as a receivable. How about what we call initial direct cost? Those expenses directly attributed to the lease agreement finalization. And they would include something like legal services, lease commission and fees, and costs related to securing the lease agreement. This is basically toward the end. You already signed, you're good to go. Initial direct costs are accounted for in the valuation. You add them to the asset, to the right of use asset, the ROU. However, any expenditure made before the lease is officially signed, such as expenses related to negotiation, preparing document, conducting credit check, and other pre-lease activities, those are not considered initial direct costs. Usually they will tell you whether they are initial direct costs or not, and you need to know they are added to the asset. So these pre-signing are excluded because they are not directly tied to the acquisition of the lease, but rather to preliminary activities. Here what you do is you're finalizing the lease. You got it, you got the signature, and you're finalizing the lease. How about how to account for non-lease components? Well, those are optional. You can include them, you may not. So lessee can choose whether to include amount allocated to non-lease component of a contract in their lease payment. Now, if you don't know what non-lease components, we covered them, pretty in depth in the prior session. Non-lease component refer to services or goods that are part of the lease contract but are separate from the right to use the underlying asset. What could be examples? Maintenance, property taxes. The lessee have the option to either include them in the lease payment or account for them separately. Specifically exclude if you guarantee the lessor debt. What does that mean? The lessor is the owner of the property. Sometimes the lessor, they go out there and they purchase the property that they're going to be leasing it back to you, to the lessee. So what happened is this: when they purchase it, they get a loan and they need someone to guarantee the loan for them. If you guarantee the loan for them, be careful, that type of guarantee is not included. So not every guarantee is included. So sometimes they'll try to kind of tell you the guarantee of lessor debt. It's not included. Now be careful, a residual guarantee, that's totally different. So any guarantee the lessee provides for the lessor's debt related to the leased asset are not included in the lease payment. This means if the lessee agrees to back the lessor's loan or financing related to the leased asset, such guarantee are not considered part of the lease payment. So those are kind of what we did. We went over the various lease payments. Now after we figure out the lease payment, we have to figure out a discount rate to discount those payments to find the present value of the obligation. Which interest rate do we use? Well, the first option is to know if you know the rate implicit in the lease. The lessee uses this rate for discounting lease payment if it's possible to determine. Simply put, how much is the lessor factoring into this lease? Usually they don't tell you this. So this is the lease, this is the rate that the lessor, the rate includes assumption about the lease used by the lessor, such as the fair value of the leased asset and an estimated residual value, which not always, most likely most of the time, not available to the lessee. They don't tell you how much their car is worth to them, how much they're factoring interest. They don't tell you this, and how much was the interest. Well, if that's not known, if you don't know the rate implicit in the lease, you would use the incremental borrowing rate. Now, what's the incremental borrowing rate? So if the lessee cannot determine the rate implicit in the lease, they would say, okay, what if I went to the bank and borrowed the money myself? How much, based on my credit, based on my history, based on the amount of the payment, how much will I have to pay? Well, this is the rate that the lessee would expect to pay for us to secure a loan. Whatever that rate is, you will choose that rate. Now, let's take a look at a couple examples and a multiple choice to reinforce what we just did. Maple Enterprises entered into a 5-year lease agreement for office space. The lease includes monthly fixed payment of $5,000 starting from the second month of the lease. So what does that mean? It means the first month is skipped. It's free. Incentive for you to sign the lease. Also, the lease agreement offers Maples an option to extend the lease for another 2 years at a fixed rate of $5,500. Is this included or not? Well, we don't know yet. Maple is considering but have not yet decided upon it. What does that mean? It means nothing for sure. It means don't include this. The lease also includes a provision for building services, security and cleaning, priced at $1,000 per month, which is billed separately for the lease. Well, in this example, the lease payment would include what? The $5,000 monthly payment, which is only for 59 months. The option to extend, as I mentioned, because it's not for sure, we did not make definite decision. There's no incentive to take it, therefore we don't include it. And the $1,000 monthly fee for building services is not included in the lease payment. Well, it's a non-lease component and accounted for separately. So simply put, we'll take $5,000 and we discount it for 59 months based on whatever discount we are using. Let's take a look at another example. Lease acts involve a warehouse space where the monthly lease payments are adjusted annually based on the local property value index, which reflect real estate market condition in the area. So we know this index. We know about this index. Lease Y is a fleet of delivery trucks where payments are directly tied to the mileage driven by each vehicle each month. So let's look at Anderson Industries. Well, the lease payment for lease acts will include the variable monthly payments because they are linked to a specific index. So remember, if it's a specific index, the local property value index, the CPI, some sort of a specific index, we do include factor those payments. This approach provides a basis for anticipating and including these payments in the lease liability calculation despite their variability. What does that mean? Because we have to estimate those additional costs and discount them to the present value. How about the delivery trucks? Well, the payment for the lease Y will be treated differently since the payments are entirely dependent on how much the trucks are driven. They are considered highly variable and cannot be estimated because we don't know how many miles we are going to drive this truck. It could be 100,000 or 10,000. Therefore, these payments will be recognized as an expense in the period in which they are incurred. We're not running away from them. Simply put, we cannot discount them to the present value and include them in the liability. That's not how we do things. So this example demonstrates how this company, Anderson Industries, manages its lease payment, including variable payment tied to an index like lease X, while excluding an unpredictable usage-based payment for lease Y, treating them as expenses as they arise. Let's take a look at this multiple choice question from farhatlectures.com. Which of the following is included in the lease term for accounting purposes? A. Let's take a look at this multiple choice question from farhatlectures.com. Which of the following is included in the lease term for accounting purposes? Is it A, only the initial non-cancelable period of the lease? Is it only? That's the only thing that's included in the term. The initial non-cancelable period plus periods covered by renewal options controlled by the lessor, period for which an option to terminate is unlikely to be exercised due to significant penalties. So period for which an option to terminate is unlikely to be exercised. Should we include this? No. If it's unlikely to be exercised, we don't include it. So let's eliminate C. Only the period covered by the renewal option likely to be exercised by the lease. Yes, we do include renewal option likely to be exercised, but not the only thing, so that's out. So let's take a look at A and B. Only the initial non-cancelable period of the lease? No. The initial non-cancelable period plus period covered by renewal option controlled by the lessor. If the lessor have the right to renew the option, we're going to have to include this. Also, the initial non-cancelable lease plus periods covered by renewal option likely to be exercised by the lessee will be correct. So even if we take D and add it to answer B, it will be correct as well. So the initial non-cancelable period plus, if it's likely the option to be renewed by the lessee, we will include it. And if the lessor can extend it, we assume that the lessor will extend it because they want to do business with you. Therefore, the answer is B as in boy. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you whether you are studying for your CPA exam, accounting courses, or any other professional certifications. Invest in yourself. Good luck, study hard, and of course, stay safe.